Hey y'all, welcome back to Charisse Says. I'm grateful for the opportunity to take you to the next level when it comes to investing and give you practical money solutions so you could have the wealth that you want. If you missed our last episode, no biggie. You can check it out at www.charissesays.com. As always, feel free to tweet at me as the show is going on. Did you know that according to research by famous economist Jeremy Siegel out of the University of Pennsylvania, stocks have returned 6.7% per year over the last century? Let's just take the last 25 years as an example of what this means in terms of dollars. If you had $10,000 in 1990 and the market grew by 6.7%, you would have $50,000 now in 2015 if you kept your money in the market. That is powerful. As you can see, the market can be a great place to put your money despite the ups and downs. But I bet you've seen commentators on TV say, the market did this and the market did that. And there's like a million pieces of information floating around the screen. And you're probably like, that's because the market can sound a lot like gibberish and put you to sleep. That's why I'm excited to get you ready and give you a new perspective on the stock market, which is our topic for today. I want to cover two main points. Number one, how does a company become part of the stock market? And number two, how does the market actually work? Before I go into the details, I want to share a little personal story. I never understood the power of the stock market until it applied to me personally, right after I got accepted to Yale University. Go Bulldogs! After experiencing pure joy, I glanced at the cost. $40,000 per year. Yikes! We didn't get any financial aid, but we're too poor to write blank checks to Yale. I now call it stuck in the middle. You can read the full juicy story on my blog. Long story short, to earn some extra money, my mom bought me $2,500 worth of Dell stock before I went off to school. At the time, I had no idea what investing meant. All I knew is that I could buy a piece of a stock and own part of the company. If the company did well, I would do well. If the company did badly, I would do badly. I went off to Yale forgetting all about that Dell stock. 4 years later, that Dell stock was worth $5,000. I couldn't believe it. My $2,500 doubled. I sold some of the stock and took the proceeds to pay off some debt. Now, my money could have easily went down if the Dell stock went down, so I want you to keep that in mind. The lesson here is that individuals like you and I can buy and sell shares of stock of publicly traded companies and thus own part of the companies. The market, which is just short form for the public stock market, can seem so daunting, but if my mother can do it, so can we all. Fast forward to today. And I know you're familiar with a couple of companies that have recently become part of the public market. A few of my favorites over the last few years are Alibaba, GoPro, and Fitbit. And that brings me to my first point. How does a company become part of the public stock market? In order for a company to become part of the market, it must be listed on a stock exchange and thus be a publicly traded company. When a company becomes public, it has an IPO, or initial price offering. Companies that tend to have an IPO tend to have very strong performance, but not all companies are eligible to have an IPO. You've probably heard of the term investment banker. These are the folks who help a company become public through an IPO and determine what price it should come out at. If I have my own Charisse IPO, I'd be doing a little something like this. That's in the Charisse world. In reality, companies in the US must register with the SEC, or Securities and Exchange Commission, and they must file a registration form called an S-1. Once a company registers with the SEC, its shares can trade publicly on a stock exchange, like the New York Stock Exchange. Companies are assigned a ticker for trading. I'm sure you're familiar with these, and yes, there are lots of them, to the tune of 1,800 just on the New York Stock Exchange. The New York Stock Exchange is the largest and most widely known stock exchange in the world. The other stock exchanges that you should be familiar with are the NASDAQ, which is also in the US, which was the world's first electronic exchange. The London Stock Exchange in England, the Japan Stock Exchange in Japan, and the Shanghai Stock Exchange in... Individuals and companies can easily buy shares of any company on an exchange, but neither individuals nor investment companies can buy shares directly on an exchange except if they go through a broker. A broker is our middleman to the exchange. They have a relationship already set up with them. We're going to talk about brokers in a later episode. You've now got all the pieces. Let's put it together visually. And that brings me to my second point. How does the market actually work? Check this out. Let's say Company D is a grocery store and is ready to be listed on the New York Stock Exchange because it wants to add 100 more stores to its portfolio. It has had strong performance. Company D approaches Mr. Investment Banker, who will get Company D listed on the New York Stock Exchange and get paid a big fee for doing so. And let's say that Mr. Banker expects Company D to have a $20 initial price offering or IPO and has 100 million shares available to offer the public. Mr. Investment Banker and his entourage will take Company D management team, the CEO, the CFO, and possibly others on a roadshow to meet decision makers at investment companies like Fidelity and JP Morgan, where I used to work, who invest on behalf of large corporations or private individuals. Then JP Morgan and Fidelity can ask questions, and Company D hopes to generate lots of interest. There's nothing too fancy about a roadshow. It's not like the circus coming to town, although some may disagree. Rather, everyone gets together in a large conference room to discuss the deal. When I used to evaluate companies on the roadshow, I asked the management team lots of questions to evaluate the investment opportunity. Let's say JP Morgan and Fidelity decide to participate in the IPO and buy some of the Company D stock for their clients. The night before the company is expected to be listed publicly, JP Morgan and Fidelity get their orders in for how many shares they want through their brokers. The next day, Company D will be available for individuals to buy it. Notice what I said. Big investment companies like JP Morgan and Fidelity get access first to IPOs before individuals like you and me, and they get access at lower prices. Nonetheless, Company D then joins the other companies, Company A, Company B, Company C, on the stock exchange. Now, Susie can buy shares of Company D or choose to buy another company, like Company A or B, through her broker. Susie determines what price she is willing to pay for any company. And then there's Bob, who can also buy any stock listed on the exchange through his broker. He may decide to sell his Company C, get the proceeds, and buy Company D stock because he thinks it has potential. There are millions of other Bobs and Susies around the world, and they are buying and selling shares all day long at the price they want. And voila! You've now seen the creation of the market, a place where lots of different players come together to buy and sell shares on an exchange at a particular price. And that's it. I told you I'd give you a new and fresh perspective on the market. And you learn two key things. Number one, how does a company become part of the market? And number two, how the market actually works. And that wraps up our show for today. Feel free to leave a comment or question on my blog at www.charissesays.com. And let's continue the conversation on Twitter. Until next time, I say keep building the wealth.